Welcome to the 10th Asia Global Institute Public Policy webinar. I am Hei Tang, the Associate Director of the Institute. The AGI Public Policy webinar series features leading scholars from universities and think tanks around the world to present current research on global public policy issues and discuss their implications for Asia and the world. The speaker of our webinar today is Professor Ramkishen Rajan, Yong Professor at the Lee Kuan Yew School of Public Policy of the National University of Singapore. Prior to joining National University of Singapore in 2016, Professor Rajan was a professor of international economic policy at George Mason University in the United States. In the past, he has taught at the University of Adelaide in Australia, Claremont McKinnon College, and Claremont Graduate School in the United States, among many other places. He has been a visiting fellow at various regional research institutes, including the Asia Competitiveness Institute, Institute of South Asian Studies, and Institute of Policy Studies. He has been a consultant with the APEC Secretariat, Asian Development Bank, and the World Bank. Climate change and environmental degradation affect the economy in far-reaching and unexpected ways, having significant implications for financial stability and future profitability of commercial enterprises. Green central banking has emerged as an important development to combat climate change-related financial risks, resulting from the introduction of green prudential measures across countries. What factors determine the likelihood of the adoption of green prudential regulations? In today's webinar, Professor Rajan will discuss the reasons behind the differential take-up of green macroprudential policies across countries' governments and central banks, based on a co-authored paper titled, "Why are some countries greening macroprudential regulations faster than others?" Professor Rajan will first give a presentation in the first half of today's webinar. In the second half of the webinar, I will be moderating a Q&A session. Throughout the webinar, please feel free to type your questions in the Q&A box, and I will try my best to direct the questions to Professor Rajan. Professor Rajan, please take it away.
Thanks. Thank you very much, Professor Tang. Thanks also for organizing this and having me. Slight hiccup with my slides, so if you don't mind that, I can't control them, so I'll have you guys on your side control them on my behalf. So let me, before I start, a few caveats. So I'm certainly no climate expert. As an academic working in the macro financial space, I'm interested in policy and try to follow the evolution of central banking policy. What is striking nowadays is the widening scope and set of challenges faced by central banks. Central banks started, we know, with a narrow focus on managing inflation and overall business cycle volatility, ensuring financial stability of individual financial institutions, microprudential regulations, and for smaller and developing economies in this region and elsewhere, managing balance of payment shocks and international reserves. They have since broadened their scope to focus more on systemic risks to the financial sector as a whole, so-called macroprudential regulations, to nurturing the development but also managing the risks of fintech, dealing with the entry of big tech in finance, concerns about market concentration, data privacy, etc. that we hear about nowadays, managing private cryptocurrencies, developing own central bank digital currencies, as well as managing climate risks. And that brings me to the topic at hand, climate risks and central banking responses. I'm working in this area with two of my PhD students, current PhD student Bhavya Gupta and just graduated PhD student Rujie Cheng, who has got a job at the World Bank. But my talk today will be, if you allow me, will be a bit broader in scope. Next slide, please. So time permitting, the structure of my talk today is as follows. I'm going to talk about climate risk and financial stability generally, central bank responses to climate risk, greening of monetary policy. Then the next half will really be about prudential policies, the types of prudential policies, simple empirical model, and results and conclusion. Next slide, please. So One of the earliest public statements made by central bank on climate change was by Mark Carney, at that time Bank of England, a very well regarded speech in 2015, as you see there. And since then, many others have chimed in on the issue, most notably folks from the central bank led by Christine Lagarde. So Mark Carney talked about tragedy of horizon. Now folks are suggesting, well, it's not really, the long horizon is no longer that long, and we don't have that much time to act, and so central banks may not have the primary responsibility as far as dealing with climate policy is concerned, but we need all hands on deck, and central banks clearly can help. Next slide, please. So if you look at, this is data from we looked at all the speeches in the BIS. So BIS has a nice portal on speeches by central banks as well as BIS management. And what you notice here is a sharp marked rise in discussion on green finance in general, not necessarily prudential regulations, but green finance in general from 2019 onwards. Not quite sure why this has taken place, but I suspect it's a combination of different things. Trump pulling US out from the Paris Accord. It happened in November 2019, I think, though it started talking about it in 2018. Expected entry of Lagarde to ECB again happened late 2019, but she started talking about the importance of central banks dealing with climate change and formation of a number of international central banking bodies on climate change. What you also note in this, the slide next to it is, so ECB clearly has been the most active in talking about it, as has UK Bank of England. Germany has also been discussing it. What we haven't done here is try to analyze what they're really talking about, but if you really read the speeches carefully, part of the German, the Bundesbank discussion about climate change has been sort of more to push back a bit with regard to the ECB being very, very proactive about using monetary policy, prudential policy to deal with climate change. The Bundesbank has been a bit more careful about suggesting it should move in that direction. What's also interesting is a number of Asian central banks have been talking about it. You have Singapore, Malaysia, etc. Their central bankers having discussed green finance. So it's clearly become a big issue for central banks. Next slide, please. So if you look at, I'm not going to go through all of this, but just to give you a sense, there have been also a plethora of international collaborations with by central banks and financial regulators on green financial issues. So probably the most well known is the Network for Greening the Financial System, NGFS, which deals with a number of issues relating to scenario planning, research, outreach, etc. The two other important, obviously all of them are important, but two other noteworthy ones are the TCFD, which really looks at, tries to develop a consistent climate-related financial risk disclosure that's used a lot by industry nowadays, and the TCFR, which is really about climate-related financial risks. But there are a number of other international collaborations as well. Next slide, please. So when you think about climate risks and financial stability, so The Economist, right? If The Economist talks about it, it must be important. So Economist, September 4th, 2021 edition talked about, had this headline, Could Climate Change Trigger a Financial Crisis? And we have a number of statements from various central bankers. This is just one of them. As guardians of financial stability and bank supervisors, we central bankers see climate change as a source of financial risk. We need to get to grips with it to manage it both at the individual level, meaning Micropru, as well as the stability of the overall financial system, which is Macropru. Next slide, please. So again, just to give you context, when we think about impact of climate change on financial stability, what are risks? There are two broad types of risks. One is just the risks that arise because of so-called physical risks, the economic and financial costs because of property and damage to property and infrastructure. The UN IPCC report again highlighted how the weather patterns are changing so dramatically. But what's interesting here is, and I don't think we have got a good handle on it, obviously, is the climate scientists have been talking about, apart from frequency and ferocity, there are a lot of non-linearities which are really hard to model. Next slide, please. And apart from physical risks, transition risks. And transition risks arise because as economies move to sort of shift to clean energy and more decarbonized world, either because of regulatory policies, climate policies, either because of shifts in technology, either because of change in consumer and investor preference. You could, some industries, some firms, etc., could get caught. Meaning, as we keep hearing about so-called stranded assets. So we hear about fossil fuels. So these are some of the headlines. BP and Shell write off billions in assets, citing COVID and climate change. Value of world's largest coal mine slashed. There was a recent legal thing with Royal Dutch Shell, but it's not just fossil fuels, it's also other industries closely related. So it could be oil tankers, it could be cement manufacturers, plastic shipping, etc. Right? And so here the big discussion is there going to be a gradual depreciation of these types of assets that are heavy users of fossil fuels, or is there going to be a sudden shift, sort of a climate Minsky moment, as it were? Are we in a carbon bubble, meaning that the assets, the current value of these fossil fuel assets are much higher than what they ought to be, and there may be a bursting of the bubble? Now, here again, we could have a separate session on this, talking about how fossil fuel industries have tried to move away, either through transition to renewables, carbon capture, greenwashing, etc. But this is the whole idea of transition risk. Next slide, please. So just to very quickly, a lot of things here, but just to, in a nutshell, essentially, when you think about the impact of physical and transition risks on the financial system and overall macroeconomy, the concern is when you have, if these risks evolve, they could negatively impact asset values and worsen corporate and household balance sheets, which then have an impact on the banking and overall financial sector in terms of rising non-performing loans, loss of asset values, underwriting losses in the case of physical risk because of insurance, or there could be operational risks in the event you have a physical damage to your data centers, etc. So the point is, these physical and transition risks could have significant effects on the financial system, and then which then could have repercussions on the overall macroeconomy. You could have this vicious cycle that takes place. Next slide, please. So this is taken from the NGFS, and essentially when you think about, so physical risks and transition risks are obviously related. So if you think about this first slide here, so this hothouse world, the hothouse world is the worst of both, where we sort of don't do anything. So it is orderly as far as transition risk, but orderly in not a good way, because things will get much worse and the physical damage can be quite acute. Or you could have a situation of too little too late, which is what a lot of people are concerned about. Yes, we have realized that we need to do something, so we start undertaking transition risk, but it's a bit too little too late, and so you have a disorderly transition, plus it's too late, so you have this physical risks which emanate as well. In the ideal world, we want to have the bottom left corner orderly. So you have sort of you start undertaking gradual transition to early on to try and minimize the physical damage. Or you could of course have the disorderly transition, which is too quick. In some sense, some environmentalists might suggest that change everything. We need to change. Singapore needs to give up its petrochemical industry. Others have to do various things because the damage could be significant. That's true. We have a fast transition risk, but that could have significant concerns in terms of physical risks and the overall economy. The NGFS also has I won't talk about this too much, but taking this broad metrics, they have sort of come up with various scenarios. So the hothouse policy would be current policies, or they could be policies not as bad but still bad enough, where you have each country having their national determined contributions which are not sufficiently ambitious, and then you could have sort of various other combinations. So the NGFS has suggested this as a scenarios framework for central banks to plan various possibilities when they think about risk to the economy and financial system. Next slide, please. So when we think about, and I'll get to prudential regulations in a bit, so when you think about, so given all these concerns, when you think about central banking responses, what are they doing? And they're doing a number of things, right? So at a broad level, they are sort of mainstreaming green finance. I mean, green finance has certainly become mainstream, and here there are various dimensions to it, trying to promote research, macro research on green finance, developing taxonomies and getting better disclosures, taxonomies in terms of what is green, how do you measure degree of greenness. We have light green, dark green, etc. Developing consistent climate related financial disclosures, etc. So at one level they're doing a lot in terms of mainstreaming the whole idea of green finance. Number of central banks are also greening their own portfolios, right? Reducing their own environmental footprints, financing decarbonization by facilitating green finance. So we hear about green bonds, green loans. BIS yesterday in their quarterly review talked about caution that maybe things have moved a bit too fast. They didn't say too fast, but basically the idea is with this focus on green and ESG, maybe forget a Minsky moment, maybe there should be concerns about a green bubble. But that's a story for another day. And then there are two other aspects, green monetary policy and green prudential policies. Let me talk very briefly about monetary policy and then I'll get into prudential policy. Next slide, please. So before I talk about monetary policy, just to give you a sense, so if you think about Singapore, and by the way, this is just because I'm here, I pay attention to MAS, you could do exactly the same thing for Hong Kong, which has been very active, and other economies as well. So just if you put them in the boxes, right, I said there are 4 dimensions, research, taxonomy, and disclosure. So the MAS has been doing a lot in this area. They've been very active in this area. They've also been very active in terms of own portfolio greening, trying to promote green finance in various ways. They've also started looking very seriously at greening prudential policies. What they haven't done is greening of monetary policy. No different from Hong Kong because both of them have exchange-centered monetary policies. But that's also true for a number of other countries in Asia. They've been doing the first 3, but greening of monetary policy has remained lagging, partly because it's controversial. Next slide, please. So when you think about monetary policy, when you think about greening of monetary policy, I would divide this into reactive versus proactive. So in terms of reactive or adapting to climate change, there are a number of questions policymakers need to ask when we think about adapting monetary policy to climate change issues. What are the macroeconomic effects of sharper and more frequent weather and climate related events on inflation and output gaps? Sort of these act like negative supply shocks. How might climate factors be incorporated into standard macro models? How does the transition, in some senses, how to model these effects on the economy depends on the speed of transition, which is also partly a policy variable. So could be affected by societal preference, etc., but it's also a policy variable. How fast are you going to undertake the transition? These are all, so the first 2 are really short-term shocks, but then when you think about the longer-term issues as well, what are the effects of climate change and global warming on productivity, potential output, and inflation expectations, because that affects the output gap and inflation gap, and how does climate change affect the transmission channels of monetary policy? So these are some of the questions that people have been asking with regard to when we are thinking about adapting monetary policy to climate change issues. Next slide, please. The other issue is more proactive use of monetary policy. Let's try and mitigate the effects of climate-related financial risks. So there's been discussion, certainly primarily with the ECB, but also other countries as well. So when we think about QE, should now QE be made green? So should we have sort of promote green asset purchase programs? But QE is a very specific issue. It seems like a new normal in monetary policy, but over time, once QE unwinds, when monetary policy is more normal, we still need to think about maybe greening monetary policy by having a green collateral framework. So corporates come to the central bank for liquidity. Should we have different haircuts for corporate bonds depending on the level of greenness? There's a big debate here about, well, does this violate the principle of market neutrality, etc. And so this is a discussion about the greening of monetary policy. It remains controversial. Next slide, please. So I just put this up here because it's become quite an issue, right? So we have, on the one hand, Powell has talked about how climate change obviously is important, but it's not directly under the mandate of, it doesn't enter in their discussion of monetary policy. The Fed doesn't have mandate there, and if mandate hasn't changed. On the other hand, Christine Lagarde has said, well, no, we need to start, the ECB does, central banks have mandates in this area, and ECB is certainly going to move in that direction of thinking about greening monetary policy. And this again has become a big political issue because left-leaning Democrats, Joe Stiglitz, etc., have suggested that Powell shouldn't be, his term shouldn't be renewed because he's not sufficiently sensitive to environmental issues. And on the other hand, some in Europe are suggesting that the ECB may be going a bit too far. So this is an open debate. Next slide, please. Now let's talk about green prudential policy, somewhat less controversial than monetary policy. So a lot of central banks, apart from doing the other things that we talked about, promoting green finance, etc., have been looking at greening prudential policy. So as I said, there's micro versus macro. Micro is focused on individual financial institutions, while the macro is focused on mitigating systemic risks of climate change on the overall financial system. Next slide, please. So when you think, so this is just to give you some examples of macro versus micro pro. So you could have macro pro as stress testing based how the financial system will be affected by different climatic risks. You could have differentiated capital requirements based on the carbon intensity of assets, difference in terms of you could have various loan to value and loan to income ratios, etc. Microprudential would be more about environmental risk management at the corporate, individual financial institution corporate level, disclosure requirements, etc. Next slide, please. So when we started thinking about working on prudential regulations, the first step obviously was to start looking across various central banks and trying to collate the data about what they're doing in terms of prudential regulations, etc., the green prudential regulations. Then we came across some other work by De Orazio and Popoyan that actually had developed a cross-sectional series on green macro proof. So we said, okay, let's start with the data set and then move forward with it. So let me show you what we have done with their existing data set. This is just to give you a sense across countries. So they have three categories: macro pro, under discussion, voluntary, and mandatory. So just to give you a sense, so it's in countries in Asia, India, China, Indonesia, a few others, Brazil, in Latin America seem to be much more active in terms of green prudential policies, making it mandatory at least. Next slide, please. So this is what we do. Quick caveat. I mean, the more you get into this data, the more you realize that trying to differentiate macro versus micro pro is not all that easy. So that's why even though we started with macro pro, I don't think we're going to be able to differentiate at this stage so clearly micro versus macro pro. So I'm going to use the more generic term of prudential regulations. So essentially what we do here is very simple. We say, well, we have this green macroprudential index that those authors have developed, and you have sort of, like I said, you have those three categories: under discussion, voluntary, and mandatory. So we just create a binary variable: under discussion meaning not imposed yet, versus mandatory and voluntary but imposed. So we're asking the basic question. It's too early to look at the issue about the impact of green prudential regulations because it's relatively new. So we can't really. Ideally, we want to look at how effective they are in terms of managing these various risks, how effective they are in reducing the amount of credit to fossil fuel and other carbon sensitive industries. We can't do that yet, but what we are doing here very simply is to ask the question: are countries that are in greater danger of various climate risks, and I'll talk about that data in a bit, countries that are more in danger of climate risks more likely to impose green prudential regulations, other things being equal? So very simple hypothesis. We just wanted to see if this works. Next slide, please. And so that's, if you will, our starting point. Of course, you want controls. We could talk about various types of controls, but what we decided to do is to have a very parsimonious model where we say, well, we could look at type of exchange rate matters, institutional structure of this, whether the central bank is in charge of prudential regulations or you have a separate entity. All of those other things may matter. But rather than complicate things too much, we said, well, all those things that matter for green macro pro are also going to matter for imposing macro pro in general. So we essentially add macro pro policies in general as a control. So the idea being that countries that impose more macroprudential policies in general, not green macropru. Countries that use macroprudential policy instruments more aggressively, other things being equal, are more likely and willing to adopt green macropru because they are used to using macropru. And also this inclusion of this general macropru policy instruments accounts for other general determinants of adoption of macropru policies. That's our basic control. Then we say, well, what the role of institutional capacity, broadly speaking. So the idea is basically this. Other things being equal, so greater the climatic risk, the more likely you're going to adopt green macropru. But institutional capacity and fiscal risk matter as well, meaning countries with better institutional capacity and greater fiscal risks might be less, the climate risk may be somewhat less, adoption of green macropru might be somewhat less sensitive to climate risk. So the idea basically here being that if the government has good institutional capacity, if the government has adequate fiscal space to deal with it, for a given climate risk, maybe they won't need to use green macropru as much, right? And so that's sort of what we're trying to test out here. Next slide, please. And so this just to give you, we don't have a formal model, but just to give you the causal mechanism. So countries more vulnerable to climate change, so obviously they're more affected by physical risk, which in turn affects the financial system. We talked about that, and therefore the policy response would be to adopt green macropru to deal with this. But institutional capacity slash fiscal space acts as a mediator, meaning if you have better institutional capacity, if you have more fiscal space, even if you have all these other types of climatic risks, more likely you're going to use those other policies rather than the green macropru policies, which then to some extent might give you a hint as to what we saw there in that map, where a number of developing countries seem to be adopting these green prudential policies. Next slide, please. So like I said, so we're using the green macropru index, but again, I'll take this with a pinch of salt. Some of them may not be completely macropru, so I'll use the term green prudential index. We use a basic probit model, so 0 if under discussion, 1 if you have it's mandatory, or you are it's voluntary but imposed. Next slide, please. So the main measure, independent variable, is your climate risk index. There are a number of there are at least 3 climate risk indices that could be used. We use the HSBC Climate Vulnerability Index. Again, our data right now is just cross-sectional. And here they divide. The reason why we got interested in this index early on was because they had a measure of transition risk. But in the end, we didn't end up using transition risk because it wasn't really about transition risk what they were calculating. It was more about the size of fossil fuel industry, etc. But in any case, they are broken up into physical impact, sensitivity impact, potential to respond, and overall climate vulnerability. So basically, we use physical impact and sensitivity to extreme events as physical risks. We don't use transition risks, or at least I'm not going to show it to you here. And the potential to respond is really, if you look at the data more carefully, or an index more carefully, it's really a combination of institutional capacity as well as financial and fiscal resources. So we use that as that mediating variable, as it were. We don't use the overall climate vulnerability index because that's a weighted average of these other 4 terms. But what we do is create our own physical vulnerability index, taking a weighted average of the first 2 components, physical impact and sensitivity to extreme events. I won't talk about the data as much, it's in the paper. Next slide, please. So just to give you a sense, again, you can read up about the index. In interest of time, I'll skip this. Next slide, please. Again, same thing in terms of the index, but just to give you a sense. So the physical, what we use is that the first indicator, which is about exposure. So water availability, average temperature changes, etc. The impact of this exposure in terms of deaths, damage, costs, etc. And then the institutional variables, which are a hodgepodge of various things. What we are doing also, I'm not going to show it to you here, is dissecting these things a bit more. Is it institutional capacity that matters more as a mediating factor? Is it fiscal resources? Is it something else? But this measure that HSBC has is really a broader measure about both institutional capacity as well as financial and fiscal resources. Next slide, please. So I'm not going to talk about the Macropru index. The general Macropru index is a control. That's from Cerruti et al. But so just to show you some of the results. So when you look at it, so just the first bivariate case. So the sensitivity risks seem to matter. So the greater the sensitivity risk, the great other things being equal, the more likely you're going to adopt green Macropru. Then so the first variable is the bivariate case. Then we throw in the control of the Macropru. Macropru per se is insignificant, but the important point as a control that the basic sensitivity risk remains unchanged. Then we try physical risks, same result, it seems to matter. And then we create our own aggregate risk, which is basically weighted average of the first two risks and also significant. So clearly there's something seems to be going on here. We deal with the lag structure. So basically we look at imposition of green Macropru in 2018 is dependent on climate risks in 2015, etc. We deal with the lag structure. I won't talk about it too much here. It's in the paper. Next slide, please. Then we say, okay, what about the other hypothesis about the mediating factor? So essentially the same regression, but now we're adding the overall capacity, and I want to focus here on the interaction term. So notice here that the interaction term overall capacity, which is, remember, a broad measure of institutional and fiscal resources, interact that with sensitivity score, you notice negative sign and statistically significant, suggesting that the greater the overall capacity, the less sensitive is green Macropru to climate risk, meaning you still the more fiscal and financial resources you have, the better institutional capacity for government to use other measures, fiscal measures and other types of things, the less likely you're going to respond to a climate risk by imposing green Macropru. Okay, just to give you a sense of what we have done here. Next slide, please. So there are a few other things, but as far as the empirics are concerned, but where we're running short on time. So let me briefly conclude. So the Financial Stability Report, recent report, again talked about climate-related risks, and they say they may be highly non-linear, and which then is a big problem in terms of the modeling of it. And it's non-linear, and their effects on financial system are subject to substantial uncertainty and tail risks. But we know that these risks are hard to model, but we understand some combination of fiscal and transition risks will occur. Next slide, please. So some say, well, why does the government have to intervene if the government provides greater harmonized and proper disclosure, mandates that of the private entities, has other types of carbon policies, etc. All of these, let the markets operate on their own. The problem is, even with good disclosure, risks are especially hard to model and therefore difficult to price in, and therefore you need some kind of prudential policies. Next slide, please. So, as I said, central banks have been using various prudential policies, and the aim of this paper, again, I don't think any empirical papers looking at the impact of green prudential policies, so this is really a first very modest attempt. Too early to look at how effective these policies have been, so what we are really looking at here is the determinants of green Macropru. Okay? And as I said here, climate risks seem to matter significantly in terms of whether you're going to adopt green Macropru, but the mediating factor is this institutional capacities. Number of issues that we could talk about if you're to poke holes in this, and I'm not going to defend this. Sample size, we have 47 countries only, annual data. When you look at the overlap between our climate risk measure as well as the green Macropru measure, we only end up with about 41 countries, so that's still a small sample. What we are trying to do is develop this over time, so we're trying to look at 2019, 2020, so at least we have a somewhat larger panel. You could say, well, why use HSBC? There are other measures, the German Watch Climate Risk Index, the ND Gain Country Index. So you could do sensitivity analysis to this, which we have done, but the broad results remain unchanged, and so that's I think it's a useful starting point. 30 minutes are up, so I think I'll stop here. Thanks a lot.
Thank you very much, Professor Rajan, for a very insightful presentation of a very timely topic. And I think you are one of the first few people who worked on this, right? You know, of course, many people talked about and researched about climate change before, but you know, in terms of macroprudential policies and monetary policies, you know, at least this is the first paper that I read about the issue. So fantastic paper, and congratulations. So there are a couple of questions in the Q&A box, but let me start by asking the first two. The first is, you know, in your regression analysis, you use basically a binary variable as your main dependent variable. I know there is data limitation, you know, you cannot go further to look at sort of the context or the details of, you know, what exactly those central banks or governments are really implementing. But based on your reading and analysis, you know, do you think those central banks who have mandates about macroprudential policies, are they really focusing on monetary policies as we usually think about, like, you know, setting, you know, interest rates in a way to prevent inflation or to reduce the output gap, or they are, as you said, giving specific mandates to companies to induce them to invest in green projects or issue green bonds. Could you speak a little bit about that? You know, is there any heterogeneity across countries in terms of how micro they're doing it versus the macro policies that we usually have in mind?
Sure, sure. Thanks for that. So in terms of, to clarify, so when we think about mandates, all central banks have a mandate to manage financial stability, financial risks, so micro, and then more broadly macro. Where the mandate is less clear is about the use of monetary policy, right? And so no one is really, if you look at central bank mandates, no one is going to say you have a mandate to deal with this particular kind of event scenario, etc. So what you look at is what the broad mandate of the central bank says. So countries increasingly are saying, well, our mandate says sustainable growth. Sustainable could be seen in two ways, right? In the olden days, when all of these mandates were written, sustainability was really about ensuring that you sustain your growth, full stop, right? It's not really sustainability from a green perspective, but of course the two are related. So one argument would be central banks that have this sustainable growth in their mandate can use all policies, including monetary policy. But the question is how to use monetary policy. So the debate in the case of the US is we don't have that mandate, Powell says. Okay, it's not written there, and so the mandate is much narrower, so there's no sustainable growth. I think I forget what the exact Fed wording says, and so they're saying we're not even going to deal with monetary policy. But the Fed is not saying we're not going to deal with other measures, right? And so the other measures, both prudential as well as other types of green finance measures. So what I would say is the following. So monetary policy, I don't think any central bank has actually has greened their monetary policy. ECB has just done a recent review and they've said we are going to move in that direction. That's probably the furthest we have seen as far as monetary policy is concerned. Other countries seem to be willing to move. Some other countries might be willing to move in this direction, especially those that don't have fiscal resources, etc. They're not sure how to do it, right? And that's because there are all these open questions, right? So that's monetary policy. So where central banks are really is in terms of promoting green finance, in terms of bonds, etc., green bonds, green bank loans, trying to promote greater disclosure of ESG, etc. So that's one aspect that they're doing. The other aspect on the prudential side that they're doing, they're dealing with it in various ways. So for instance, again, still relatively new, but they're liquidity. So if I'm provision of liquidity, I'm going to give in the olden days we said, well, central banks in developing countries had all these financial inclusion measures, right? So we're going to try and get our central commercial banks to provide liquidity to the rural sector, to areas that's SMEs, to areas that we want developed. So developing countries are more used to a non-neutral kind of policies in that sense, so they are moving towards the green. Developed countries are starting to, in a more sophisticated way, trying to look at capital adequacy measures, etc., to see whether those policies can be greened.
Great, thank you. I have a second question, and I was intrigued by your empirical results that countries that have higher institutional capacity appear to be less likely to use macroprudential policies to deal with climate change. Can I interpret that as the following? And that is, those countries probably have more instruments, more policy tools to deal with climate change. And they probably think that central banks should be more focused on what they're good at, meaning setting rates to influence inflation as well as employment. Would you agree with my interpretation, or there's something deeper that I overlooked?
It might well be. I think in some senses, so I'd say the first part, absolutely. I mean, and said it more eloquently than I did, which is you have more instruments to deal with, right? You can deal with the you can use fiscal resources, right? You can, or if you get your act together, you could have sort of a carbon tax or something along those lines. So when you have a government that's willing and able to deal with these things, it doesn't have to lean on the central bank to broaden its scope to deal with various things, because after all, and we know the central bank is a non-elected body, right? And so where governments can deal with it either from a fiscal side or financial side, if they have sovereign wealth funds, etc., or they have the capacity to get their act together to put in certain policies, carbon tax policies, etc., in countries where it's not where it's easier to pass these laws. They are willing to do it, as opposed to asking the central bank to do it. So if they don't, then yes, the central bank plays more of a role. That's our hypothesis, and again, from what we seem to, we set out that hypothesis, that's what we seem to find. It may not exactly be right, but that's what the empirics seem to suggest.
Great. Let me go to the Q&A box before I abuse my power to ask more questions. There's one about advocacy. Is one of your fan of your research, I guess. He said, well, is it too early for countries to talk about monetary policies when the public may not be fully aware of the climate risks, and therefore they may not be supporting those monetary or fiscal policies? So the question is about advocacy, right? Especially in those countries that you highlighted in the map, right? Many of them are in developing countries.
Right. So it's a fair point. I'd say the following, right? And let's focus very specifically on monetary policy. It's taken a long time for central banks in a number of developing countries to develop a narrower mandate of inflation targeting in many countries. Take a back seat, privatize the commercial banks, move from state-owned to more private to the private sector, and so we have gotten used. It's taken a lot of time, but we've gotten used to the central bank becoming more disconnected from the fiscal side, becoming a bit more disconnected from ownership and supervision, from ownership perspective from the commercial banking side, and focus on what they're supposed to do, right? Which is conventionally dealing with the output gap and inflation gap. And I think they've been very successful. Now, you could debate whether they become too narrow, they haven't dealt with food price shocks, etc. But the point is they've been successful at that, and it's not been an easy movement from the good old days of when we had central banks monetizing the deficits, etc. Right? And so then to now suddenly say, let's broaden their mandate and let's start looking at all of these things, could erode the credibility, number one. Number two, it may also become an issue of, well, why stop just with green? Why not go back to the good old days? If you can deal with green, well, I have industrial policy tomorrow. I want the central bank to support that particular industry X, Y, and Z, and it's hard for them, central bank, now to say, no, we are independent, etc. We are supposed to have non-neutral policies when you're doing this. And so I appreciate the concern there, and certainly the point about advocacy, you also want to make sure that society understands these concerns, and so you want to message why if central banks are going to move in that direction, why they need to move in that direction. So I appreciate the question, but having said that, in some cases I think it also goes back a bit to institutional capacity, broadly speaking. Sometimes it's question of in the ideal world, you want to make sure everyone comes on board, understands why we are switching focus a bit, or adding to the central bank mandate, as it were, in some cases. But given that's all going to take time, and remember the NGF table we're already sort of in the hothouse, or too little too late. maybe we just need to move. So in the second best world, maybe we just need to move, and hopefully along the way, we also promote advocacy.
Great. Another question. Let me read it to you. Professor Rajan, would you please tell us more about how MAS or the Singaporean government has done to deal with climate change?
I think this is, in some senses, so Singapore is actually a good case study in the sense that we had this MAS has come out with the green financial plan, and I don't want to say almost simultaneously because I forget exact timing, but the government's also come up with an overall green plan. So in some senses it's related to the first question, where this is what you'd like to do. You'd like to advocate, show that you understand, tell society why this is important, etc. Show that you're using other measures as well, but also the central bank is part of that entire thing rather than doing it all by itself. In terms of what they are doing, that like I sort of showed very quickly, I know it was too quick in that table, they have these three dimensions. One is, like Hong Kong, they want to be the center of green financial activity, as it were. And competition is good, right? And so they're trying to promote green bonds. They're trying to promote green loans. They're doing a lot more. I think where they probably seem to be doing a lot more than some other countries is, one, working very closely with international institutions. I don't use the word institutions loosely. So the NGFS, the other types of task force, etc. They're working. Because all of this is relatively new, Singapore is really working very aggressively with all of these new bodies to come up with the template, the best practices, etc., which they are implementing almost simultaneously. Right? They're not trying to invent the wheel on their own. So in terms of prudential regulations, in terms of disclosure requirements, etc., they're working internationally and then working with their own domestic bodies, industry bodies domestically to implement. And I think that's where Singapore, being a small country, can move very quickly. Where they're also moving quite rapidly is in terms of research. Advocacy, yes, but research in particular. They've already created, in the last year or two, they've created 3 research centers. One with NUS, one with SMU, and one other, I think, with industry, to look at various aspects of green financing. So this goes back again to the first question about advocacy, research as well as advocacy. So they're doing a lot, again, in terms of green financing. They're doing a lot in terms of advocacy. They're also working in conjunction rather than and in parallel with the government, working with international institutions. And also, I should say, they have taken very seriously dealing with their own carbon footprint. I mean, MAS has said we would like all commercial banks to follow suit, but you can't obviously mandate for commercial banks. You have to do things in-house, but they're leading by example in terms of greening their own reserve portfolio of reserves. They've gone so far as to say we're also going to try and reduce the amount of international travel that our central bankers are doing, because we understand it's all part of promoting society moving to a more get more aligned with green policies.
Good. There's a very long question in the Q&A box. I don't know if you can see that, Professor Rajan, but I'm going to read it to you as well as to the audience. Last night, Ken Rogoff described the case for central bank climate change activism as tortured. While well-intentioned, it seems like a case of if you only have a hammer, all problems look like nails. There is little evidence that they are likely to be targeted and efficacious. But at a time when the world economy needs to pick up, they may have a slowing effect. Importantly, the Europeans have not met their 2009 pre-Copenhagen climate financing commitments, and much of this is seen as diversionary. Yeah. So what do you think about this?
It's a fair point. I'm just trying to see what angle to come at this at. So the idea is the following, right? We say, well, and Ken Rogoff, I'd like to look at exactly what he said, but there have been people, John Cochrane and others also have criticized this and said, well, we know that the central bank should just make sure that there's greater disclosure, etc., and leave it at that, don't use any non-neutral policies, etc. So I think there are a couple of things. One, I would say, because the Europeans and many other countries haven't met their climate financing commitments, rather than saying, well, you need they need to do all of this and everything else is diversionary, there are probably reasons why they haven't met it, and therefore that's also the reason why central banks feel they need to get into this act and deal with some of these issues, right? I think that's one way of thinking about it. Could this be diversionary? Possibly. I mean, but I guess the question is, what's the alternative? Meaning, if central banks are doing this partly because the governments aren't getting their act together. If central banks don't do it, will governments necessarily get their acts together? Probably not. But the argument here as well, that seems to be in this question as well, if the central banks do get in, there may be sort of an issue where the governments decide, well, okay, central banks are doing it, so we can even go even more slowly on this, which is a possibility. I just don't know. My argument would be, it's because governments haven't gone as aggressively as they should have in some cases, central banks have felt it's necessary to get on board. By the way, we could make the same argument about monetary policy, right? Central banks have come in too aggressively, whether it's global financial crisis, COVID, etc., and that's sort of taken some of the burden away from the fiscal authorities to deal with some of these things. So that would be the second part of this question that I'm looking at. The first part, it seems like, I'm just quoting here, while well-intentioned, it seems like a case, if you only have a hammer, all problems look like nails. True, but again, I'd say in this particular case, there are, I'm trying to figure out how exactly to respond to this. I think the problem is a real one, right? The debate really is, should the central banks be intervening? Absolutely. How should they be intervening? So in terms of green finance, etc., they should be doing it. Whether they should go further, greening of prudential regulations, greening of monetary policy, etc., can we go too far too fast? Possibly. That's why monetary policy, we've been a bit more careful about it. But I'd say, so I'm sensitive, I appreciate this question, but again, I think it's not sort of black and white. I think the central banks do and should have a role in this.
Good. A new question just came in. Are countries with a greater public awareness more likely to adopt prudential practices? And the participant is curious about whether there is a way to measure countries' climate change awareness.
It's a good question. I don't know. I mean, the best we can do is ASEAN, for instance. A couple of days ago, I just done a survey on some measure of awareness of society, right? And so how awareness in terms of different age groups, different types of what are they aware about, etc. So I think the best you can do is to do a survey on this to figure out climate awareness. But again, it goes back to the basic issue about the first question, which is, and I think that is a missing link, and even to people like me in macrofinance, right? I mean, you said that this is one of the first papers. I think so, but partly because it's not something we pay. We know we need to pay attention to it, but we don't pay as much attention to it, right? And if we as academics in different areas who are not climate scientists feel that way, many other people who may not be directly affected today probably feel the same way. So is there a measure? I don't think so. The best you can do is surveys, and those surveys have started.
There's no more question, but let me ask the final one. We have 2 more minutes. And that is, let us step out from the central bank framework and think about the financial market in general. Do you think the financial market has been pricing potential climate risks right? And do they even have the right model to think about those likely but unexpected events?
No, for the simple reason that disclosures still are lacking significantly, right? Everything to a large extent. So one aspect is, am I aware of the extent of how affected I'm going to be, how my portfolio is going to be affected by this, and two, even if I know, can I model it, right? And on both cases, no. right? And so that's why everything really hinges on disclosure, much better disclosure. We talked about MAS, that's something that they're taking very, very seriously. Try and get a much better handle on disclosure. But that itself is creating problems in two ways, right? One is when we think about this, when we think sort of about disclosure, now we have a lot of greenwashing going on, right? BIS, yesterday's report talked about a green bubble. And how could a green bubble occur? Well, if there's too much money going into so-called ESG type of investments, and then at some stage we realize that, well, some of these aren't as green as we thought they were, right? And then suddenly that bubble could burst, right? So they pointed out, I think, made reference to the Nasdaq bubble collapse as well. So there's a possibility. So to answer your question, disclosures aren't complete, certainly are very partial, and we still don't have a good taxonomy yet. What is green? How green is green? BP, for instance, now suddenly calls itself beyond petroleum. Right? And so everyone's starting to talk about, so everyone's starting to say that they follow ESG criteria, they are much more green, etc. So it's we need much better template and definitions on that. And even if we have that, the question is, how do we properly model this? I don't know the details. So MES, for instance, at a micro level has started stress testing at the insurance level. Right? I haven't got the details yet about exactly what they have done or how they have modeled it, but that would be interesting. I have looked in more detail trying to understand those central banks that are starting to do stress testing, at least at a micro level, how they are doing ESG type of risk management or requiring the institutions to do it. I still haven't got a good handle on the mechanics of the modeling.
Great. Thank you very much. In the interest of time, let me conclude today's webinar. First of all, thank you, Professor Rajan, for his sharing and wonderful presentation of an important paper. And I think we all agree that more needs to be done to deal with climate change and potential climate risks. It's good to see more research and more discussions on this topic. And I think we're still far away from having a robust model, both financial model or even economic model, to fully understand what are the optimal policies to deal with climate change. But we are all in the right direction. More has been discussed in the public. More researchers like Professor Rajan has been working on these issues, and I encourage more people to talk about this in the near future. It is probably one of the most threatening risk that we're all facing. Okay, let me close this session now. And the last thing I want to discuss is ourselves. Please, the AGI team, pull up a slide to talk about our presence on social media. Please follow us on various social media platforms. And today's event will be posted on YouTube and on our Facebook page later today. Thank you, Professor Rajan. Have a good day.
Thank you very much. Thanks a lot. See you.